Every single Wednesday, 4:30 p.m. Central Standard Time, we come to you with Want to Know Wednesday. Please subscribe to the YouTube channel, share it, leave a comment. Today we're actually going through the comments from last week's post and answering the questions for the Want to Know Wednesday. So make sure you're in there asking the questions as they come up. Share it with other people who might be interested in this stuff as well, so they can add questions so that we can continue to create great content here on Want to Know Wednesday. That first question comes from Dante Owens. He said that they want to know how we calculate our deals and what type of markets do we really like to hammer in. Do we like to go after cyclical, linear, or hybrid real estate markets? Also, he also wanted to know whether determining factors play a role in the deals that we buy. Like, do we focus on wage growth in the areas, opportunity zones, multifamily, or strictly cash flow? He's just looking to understand as much of the deal analysis sauce, as he calls it, that we're willing to share. So, I mean, I'm willing to share all my sauce. You know, I don't really have any secrets. This thing is not rocket science. This isn't Tesla. This isn't SpaceX. What we do has been proven for decades and decades and decades and decades and decades and decades that a lot of people, average Joe Blows can be successful in real estate. And I'm an average Joe Blow being successful in real estate. I just have courage, right? If you have courage, you can go out and be successful in this thing. So going through, he's talking about what type of markets do we really like to hammer in. And then he talks about cyclical, linear, hybrid real estate markets, et cetera, et cetera. I guess me just talking at a high level from what we like to invest in from a standpoint of market type is, number one, if you're talking about market from a standpoint of market timing, when the market's up or if it's down or if it's flat, we like to actually invest all the time. It doesn't matter what the market is exactly like. I truly believe in investing all the time and continually, not trying to time the market, right? You hear people talk about this all the time in the stock market. You're never going to time the stock market perfectly. And if you miss the top 10 days in a 10-year span, you're actually going to cut your, they say something like you cut your returns by 15% or something like that, right? So we never want to stay on the sideline because, number one, we always want to be playing offense so that our equity can grow, our capital can multiply, right? But also, from a real estate standpoint, we're always investing because we always need new depreciation to offset properties and other investments that we make that are successful and throw off a big tax liability. We want these other new properties that we're investing in to obviously cash flow. We're not just going to go out and just get a deal just for the depreciation, but we want it to cash flow. But if it's cash flowing, if we need as investors, there's deals where I'll have one or two investors, is all three investors in a deal, because we'll take a little bit less cash flow, maybe 3%, maybe 5%, and like our odds going forward that we can increase that cash flow, but we want to be able to get the depreciation up front to be able to wipe out our taxable gain in 2021 or 2022 or 2023 or 2024, right? Any given year. So there's a play like that, and to play like that, and with when you get to have those type of problems on your mind, it's even more reason to be able to invest consistently. Anytime that I also stop investing, my money is just not going to multiply. Like, what am I going to do? Just sit there and continue to stack? I truly believe, yes, there are times that you need to have more cash on hands than other times. But relatively speaking, at most of our properties, we always have quite a bit of cash on hand because you never know when, some issue's going to come up that you're going to have to take care of, right? That's kind of my mindset on that in the markets. If you're talking about what type of markets from a standpoint, because he starts to ask about like opportunity zones, wage growth areas, areas of increased population. I think for us and for me, there's a lot of people that are like, man, you need to be in Texas, you need to be in Florida, you need to be in South Carolina because the amount of influx of people is increasing substantially, right? Their populations are growing. You got people leaving California going to Texas. You got people leaving New York and New York, New Jersey, and headed to Florida, South Carolina, right? So people are like, you got to be in those states because of the influx of and the huge population growth. But what I always counter is I'm like, but when you're looking at population growth, you also, on the flip side, which no one ever talks about this, on the flip side, you got to be able to look at how much new supply is coming on, right? Because if too much supply is coming on and you have an influx, you can still be oversupplied and be in a tough spot, right? So you need to be able to pay attention to that. So the markets that we're investing in, we might not, for example, all of our stuff's in Wisconsin, right? And I'm getting a lot of California, Florida, New York, Texas investors that are starting to invest with us because My thing to them is, hey, we might not have that big an influx, right? We might not have that many people coming in, but the communities that we are investing in are growing, right? Maybe a 0.75% annually, 1.2% annually. They're growing, but there's no new supply that has come on in the last 10 years. And over the next 3 years, there's no new supply that's coming on. Now, the exceptions of that are, where we're invested in Madison, which is a third of our portfolio, and then maybe like about 15% of our portfolio is in the Milwaukee area. Those areas do have supply coming on, right? But when you look at how much supply is coming on versus how many people are coming in the area, it's still tighter than that of like Florida, for example. Now, I think everywhere right now there's such a shortage of housing supply. We're 5 million homes short of what we need, right? So it's not an immediate issue in most places anyways. But for us, when you have people just sitting there, hey, you need to look where the population, but you also need to look at what's going on with supply in those areas as well. And for us, we're investing in areas that are growing, where there are increasing wages, where there's a diverse amount of jobs. It's not just one manufacturer where that all the people are relying on for work, but there's different government jobs, there's tech jobs, there's financial industry jobs, there are financial services, I should say. There are, UW-Madison, for example, in Madison, it's a huge employer, right? Sub-Zero and Wolf and Alliant Energy and Spectrum, right? So we have in the markets that we're investing in, whether it's Madison, Milwaukee, or anywhere else in Wisconsin, there's a diverse employer base. So we look at that. That's what we look at, and then obviously it comes on to cash flow. We're still never buying a deal that's we're negative cash flow day one. Have we done that before? I think maybe once or twice. But because the upside was so great and we were able to get there so quick, they were like, hey, this is a no-brainer. We need to do this, right? So cash flow is still number one. Other questions that came on. Connor Daniel, what are your thoughts on the build-to-rent asset class? So my thoughts on the build-to-rent asset class, I think they're great. I mean, we're this BFR, which is build for rent, and SFR, which is single family for rent, or single family rentals, build for rentals, build to rent, whatever it might be, BFR, SFR. We've already got some of that product. Now we're not building, but we have some single family like product where we have 32 duplexes. We're adding to that duplex count. We're going to have another portfolio of duplexes come on here soon, and that's been some of the best performing stuff, which is very similar to this build for rent, right, and this single family rent model. But again, if you're going those routes, you need to be able to have it in scale, right? You can't just, I'm still not looking to just go buy one single family house or build one single family house. If we're going to go at some point and do this SFR, BFR, we would do it at scale where there'd be 400 homes, right? And probably some smaller apartment complexes included in that as well, and duplexes and 4 units, and then single family homes, because we still want the scale all in one spot. We don't want to be shotgunned all around the country with, 4 single-family homes in Wisconsin and 3 single-family homes in Florida. I don't want anything to do with that. I don't want anything to do with VRBO. I don't want that. I want scale and to be able to get to scale in our areas. But the build to rent, those duplexes I'm talking about, they've been some of our best performing product. We've been seeing trade outs of 20 to 50%. What a trade out is when someone moves out or when a new lease is signed. It's basically any new lease. So whether they move out or someone stays and signs a new lease for another year, we're seeing increases of 20 to 40. Some of the stuff we're seeing 50% increases on the stuff where it goes vacant and then we're re-renting it out, just because of what we bought is so far behind, but also because the demand for those types of spaces has really increased. People want the private entry. People want larger space. People want a yard. People want, we have a bunch of people that are ages 28 to 40 who are looking to go buy their first house or whatever, and they end up like, hey, I don't want the headache, but we need more space. And so they're kind of coming into these areas, and they've been great deals for us. So I think the build to rent asset class, Connor, if you're building, how much scale can you build? If you can build 1, find a way, how can I build 10? If you're looking at building 10, how can I build 50, right? How can I get more scale? Then Mitchell asked, what do I think the best way is to build relationships with investors? And I think the best way to build relationships with our investors is number one, you have to cast as wide a net as possible. So you have to share what you've done, what you're doing, and what you're going to do with every single person that you come across. It could be, it doesn't matter who it is, every single person. You can't prejudge them. You have to share what you're doing, because doing that, if you make it known what you're doing, people are going to want to help you, right? But if people don't know what you've done, don't know what you are doing, don't know what you want to do, they're never going to be able to help you. So you got to be able to cast a wide net, share that with everybody. You got to create your little elevator pitch, right? That 3 parts of what I've done, what I'm doing, what I want to do, that can be in 10 seconds, 15 seconds, 20 seconds, where you can say it. And then what I do is I find a way when I say that, and if I find even they are a little interested, I'm trying to get a business card, I'm trying to get their email, I'm trying to get their contact information so I can add them to our database. Once they're in our database, they're always seeing the deals that we're bringing to market, right? We got a database of like 1,000 investors that are always getting our stuff. 200 or so have invested with us, right? That other 800, they're going to invest at some point. It's just a matter of when, in my mind, right? And so now they just keep seeing our opportunities and seeing our progress. So you need to find a way to, as fast as possible, fill a pipeline and fill a database with, you'll start with 10 people. Okay, you go from 10, it's just like the scale thing that I answered with Connor's question, Mitchell, like you start with 10, you got 10 people, all right, now go find the next 90. Now go find the next 900, now go find the next 9,000 to add to your database, get their cell phone number, get their email so you can send them updates, and then you got to go find and have a deal pipeline, right? Then the next best thing is get someone to invest, and you want to know how you really build a relationship is send them their mailbox money, get them their ACH direct deposits of their distributions, right? And start to show them through the results what's going on, and you're going to have people that will invest with you, and they'll throw $100,000, $200,000, $1 million, $5 million per deal for every single deal that you do. And the thing is once you do 10 deals with someone or 5 deals with someone, they get to the point where like they get to a point where they've had so much success with you, they're not even going to ask you a lot of questions. They believe in what you're doing, and they want to be a part of it, and so they're going to just continually $200,000, $200,000, $500,000, $500,000, and they'll get to the point where they're not asking as many questions because they have faith and they believe in you. So that's ultimately kind of the best way to build. Now going back, I'll share a little bit more context to really help you here. When I say you need to share your story of what you've done, what you're doing, and what you want to do, those 3 parts of it always apply no matter what phase you're in, even if you think you haven't started, right? And so, Mitchell, for you asking this question, where you're at right now and what you have done, it might be a learning phase. It might be just a straight up desire to be successful in real estate. It's something. Maybe it's you bought 1 unit, but if you haven't even bought a unit, it's the desire, it's the vision, it's what you want to do, right? It's what you're hopeful for. That's kind of what you've done. What are you doing to learn? Who are you surrounding yourself with? What are you doing, right? Now, maybe you've already got 10 units or 20 units, Mitchell, so obviously you share the success of those 10, 20, 30 units, right? And then you share what you're doing right now. What are you currently doing right now to advance? So it's a progression, right? What you have done is not as good as what you're doing right now, or not as big, and what you're going to do is much bigger than what you're doing right now, and obviously what you have done. Right? So what you're doing right now, Mitchell, should be that next step, right? So if you're someone that you've already closed 10 units and that's what you have done, and you've got 10 units and this is how they're performing, what are you working on right now? Hopefully you're working on like a 20 unit because you're scaling up, right? You're making that next step up. And then what you want to do, hey, I want to go out and have 100 apartments, right? So like when I was just starting 10 years ago, I would basically say, hey, I've spent the last 3 years learning because that's what I did. I didn't buy anything yet. So literally, I'm super obsessed with real estate. I spent the last 3 years learning about this. That's it. That's as simple as what I was doing. What I am doing right now, hey, I got a 4 unit under contract. We think we're gonna double our money in about 2 years. And then I share what I want to do, and this is where I went crazy with them. I'm gonna have 50,000 apartments one day. I was saying that 10, 12 years ago. And it was that quick and that simple, but I was telling everybody, and some people were like, yeah, okay, and now here we are, we're 5% of the way there or something. Is that good? Is that the right math? Yeah, it's about the right math. 5% of the way there. And we're moving along. The only way that I've had this wave of momentum over the last 10 years is because I shared that. And obviously, as you move forward, that story changes. So once I closed on the 4 unit, 6 months later, now it wasn't, hey, I spent learning the last 3 years. It was, hey, the last 3 years I started learning about real estate. I really wanted to do this. Now I got a 4 unit. We've already increased rents 20%. Right? So now what are you doing? Right? Now your story changed. Oh, now I got a 47 unit under contract down on the river. Right? And hey, we're headed to 50,000 units here in the next 15 years. You need to continuously do that and then get those people's contact information so that you can continue following up. I've never had someone, I've had maybe one or two people say, hey, take me off your list. You just continue to build a relationship that way, and then once you get an investor, take care of them, perform for them, communicate throughout the process, and they're going to be lifelong investors with you. They might invest with they might invest in your next 100 projects over the next 20 years. So that's my advice, Mitchell. Thank you guys so much for joining us on this Want to Know Wednesday. Every single Wednesday, 4:30 p.m. Central Standard Time, we are dropping a Want to Know Wednesday. Please subscribe to the channel somewhere around here. Danny's going to put it. I don't know, it might be down here. Put the notifications on. Leave a comment on what you want to see for next week. Ask a question. And please share this with someone who'd get some benefit out of it. Thank you.